These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome back. In the past couple of weeks, we've looked at both sections 21 and 22, denying allowances respectively for buildings and structures. But we also noted that both of those sections are subject to section 23. Section 23 is headed Expenditure Unaffected by sections 21 and 22, so for certain specified types of expenditure, it overrides all of the restrictions in sections 21 and 22 that we were looking at in the past 2 weeks. Section 23 can usefully be divided into two. Subsection 2 lists various other provisions of the Act, for example in relation to integral features. If we then go to those other provisions, we find a positive statement that the expenditure in question does qualify for allowances. So, for example, the cost of integral features is qualifying expenditure, and we do not need to worry about sections 21 or 22 or about case law definitions of plant or machinery. And we'll return to integral features in 2 weeks from now. For now, though, I'm going to focus on List C, which is introduced by subsection 3. List C is too long to reproduce here on screen, but if you have the Capital Allowances Act to hand, you may like to pause the video and find section 23. Rather than working through every item of List C, I want to bring out some general principles as to how it works. The key point is that the effect of being included in List C is that a given asset is freed from the statutory restrictions of sections 21 and 22. But it does not necessarily follow that the item in question qualifies as plant or machinery. A cold room, for example, is clearly a building or incorporated in a building. As such, it is caught by section 21, and if that were the end of the matter, no plant or machinery allowances could be given. However, section 21 is subject to section 23, and so we can search for a let-out clause in that later section. Item 4 at List C in section 23 specifically refers to a cold room, so we can stop worrying about the section 21 restriction as it no longer applies. Incidentally, item 18 also refers to cold stores, and whether there is any real distinction is not immediately apparent. So we've dealt with the section 21 problem, but we're not yet home and dry because we still need to determine whether a cold room qualifies as plant on ordinary case law principles. The answer will depend on the nature of the cold room and will have to be determined in the light of all the facts. Sticking with List C, another illustration can be given with item 13. Remember that section 21 told us that expenditure on walls does not qualify as plant or machinery. Item 13 at List C then tells us that that restriction does not apply to partition walls where movable and intended to be moved in the course of the qualifying activity. So where a partition wall is movable and where there is a genuine intention to move it in the course of, for example, a trade, the statutory restriction on claiming allowances is disapplied. The question of whether or not the partition will qualify is then to be decided on case law principles, and there's a good chance that it will. There's more that needs to be said about List C, and we'll stick with that same section next week. I hope you can join us for that. Thank you as always for watching. I'm Ray Chidell. These talks are brought to you by Claritax Books and sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.